This is the biggest pattern of our favorite setup we've ever traded. And I've been in the markets for ages, by the way. This started in my childhood in the run-up to 1980, this setup. And that was our triggering point to go long right there. And you can see this is 3 months, that's a quarter. Each candle represents 1 quarter of a year. And this target that we get out of here is way, way up at $330 on a log scale chart. And then we see 600, and then we will see 4 digits. We've called for a single digit gold silver ratio in an overreaction moment period. That means 9.99 potentially or lower in gold silver.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we have a timely and dynamic discussion lined up. We're fortunate to have with us Francis Hunt, founder of The Market Sniper. Francis, it's a privilege to have you back on Metals and Miners. Welcome to the show.
Delighted to be back with you, Gary. Thanks for having me on.
So, Francis, you've been a trader, an analyst, an educator in the financial markets for more than 30 years. Your experience gives you an edge in this incredibly unique market time that we're in and living through right now. What do you hope for those tuning in to our conversation today that they'll walk away with after listening to our discussion?
That's an excellent question, and I believe I have hopefully a suitably good answer. If people are giving time, as your guests are doing, Gary, to both of us, can they get something that's a takeout that they didn't have before that they can apply? And my key, in fact, this is a frustrated book. I should be published way more. I'm not yet published. I should be published on a number of things. The key template I want to hand everybody to measure, so the new measuring stick. And it's more than just a measuring stick. It's a conceptual understanding of the entire fiscal, economic, worldwide setup that we are in. And most people don't have this. Most people are incorrect. Most people are confused. We are, number one, in a fiat and debt debasement cycle. This is not anything of the scale you have ever seen before. You've had your Venezuelas, you've had your Zimbabwe's. This is Western world, including Japan, and of course, Commonwealth, Australia, Canada, New Zealand, thrown in with Europe, UK, and USA. And they are all going through what I am describing as the fiat debt debasement. I intentionally use the two together because people think that you can have a major devaluation in debt without having a commiserate devaluation in the fiat purchasing power going with it. Money is borrowed into existence. I refer to them as Siamese twins conjoined at the head. You can't drown the one baby without drowning the other. Sorry for a little bit of a gruesome analogy there. That's point number one. If you can get that, you already know why someone like you and I are positioned in gold, the millennial, multi-millennial, long-standing reserve asset for generations. That becomes especially significant when you are in point number one times fiat and debt debasement. And what actually happens is trapped, captured, non-upside moves in gold when it should have been linear, like a dammed river that is building pressure behind the wall over literally most of my trading career, the financialization of everything, the manipulation of metal markets, everything else, water pressure building on the dam wall. The peasants have built villages downstream or next to the trickle that is occasionally let out, and the wall is now breaking. This is bigger, larger, more violent than any most people I come across even understand. So we have thrown out some of the scariest numbers of all. not to try be the biggest bull. I hate the people that just without any reason will go over the top. We have technical targets and we have fundamental targets, but this is the largest, and people don't understand the scale. I'm going to stop there and I'm going to come back to the others. I want to give another point because I've given point number one. Economic history scaled the entire hemisphere of fiat and debt debasement, which essentially is huge. Cost of living in all those nations that I mentioned is going to get incredibly high, and the quality of life is going to go down immensely for most people. So much so that from my own YouTube channel, I've been preaching, leave. Now, that's not a very popular message, especially when people have kids and many other entanglements with home. I say you can always go back on holiday there in time and it'll get cheaper with every visit that you make if you've moved outside of that Western hemisphere, including Japan. But it's not a popular message. It's that bad. And just to highlight that, I say, you know, I'm a better surfer than Kelly Slater because I've given him an ironing board and I've sent him on the flat Mediterranean Sea, and I've got a proper piece of kit, and I'm down Cape Town where there's real waves. In that environment, I outperform him because he has been ill-equipped and been put in a useless environment for competing with me. So even the best, hardest workers will battle in a depressionary environment, unless you move into the mortuary business, which probably will do quite well, and the antidepressant business, which is largely sewn up by Big Pharma. Anyway, enough on that. That's point number one. Point number two to the template is that two forces can simultaneously exist. One is recessional forces, the consumer being damaged, the demand not being there, and you're talking about part of that cost of living that I referred with the fiat and debt debasement, which has already begun and is having its effect. And within that, you can have effectively what is an inflationary force, which is the fiat devaluation, the debasement. Those two can coexist. It's kind of like global warming and global dimming, et cetera, et cetera. These things can happen at the same time. That's not a vouch for climate change, by the way. I'm on the other side of the world on that. But what people only notice is the net effect of these canceling out forces. And they fail to realize that these things can exist. Why do I say that? Everybody is saying, wow, all the influencers on X, and we've made two big calls involving oil. In 2019, we called for single-digit oil. This is early 2019. We repeated it in August, regularly on our YouTube channel. We were in an event in November, and then we were on a stage in Acapulco in February. All throughout that time, the oil was $67 or higher, and we said single-digit oil. But what the other part of that trade was long gold. So the 2019 that then ended up at the 2020-21 high, long gold, short oil, which was a perfect delta hedge that if there was inflation and oil actually went up, you would also be benefiting in the gold. So it was actually, by having two legs, more neutral. Oil traded zero, and in the futures markets, negative. And gold made a localized high in the tail end of 20 going 21. We recalled that exact same trade a year ago and I will show you the charts when you're happy to do chart share. I know you want to have dialogue first, and I'm still answering your first question. But we called it the exact same, inverted head and shoulders on gold relative to oil, and said, not only is this a reversal and it'll run from, it was as low as 14 barrels you got on a gold ounce when oil snapped back after CV19 events. It went as high as 129, you might recall. And you only got 14 barrels. We said we're going to 63. And that's going to be the target, but in actual fact, after that, you're going to continue a reversal to new highs. What happened? The crisis is a fiat and debt crisis as a result of the additional proliferation that occurred in CV19 that suddenly brought debt straight to the forefront. This is a debt problem. This is a debt debasement problem, and the fiat is a part of that. And oil goes down on account of the recessional consumer. We have a two-tier economy. which has the insiders of NVIDIA and server centers and Palantir that are stuffed with government contracts on debt. Remember, America spends more than it gets in, almost twice. And they are having a feast, but that is a twisted balloon. You know, the clown that makes something for your kid, there's two halves. The other half, the consumer half, your half, private businesses, is all being crowded out by state. We're going from a capitalistic small state model and price discovery and light regulation into largely government as everything. And we're in the tail end of the private business world, and it is being deflated. And that's where most of us live. And that's why you have a wrecked consumer, you have housing market concern, you have a variety of reasons, people hurt by the interest rates, and you have the oil price collapse. We actually have right now, for the demand that's in the economy, which is low, a glut essentially of oil and dollars, and a shortage of silver and platinum, and a potential future shortage in gold in terms of private hands, but not at this point so far. So hyper stagflation, the 1970s, only much larger by degree, scale, and intensity. So you'll have a worse economy with a higher level of inflation. It's not hyperinflation yet, because of the dimming forces of the crushed consumer, the job losses, the lagging wages, is counteracting to a degree. So I talk about having 1 foot in the ice bucket, 1 foot in the fire, your body temperature is 36.4. I might on aggregate be at 36.4, but in actual fact, those are two very aggressive forces. One is numbing my foot off, and it'll eventually get, what do they call it? The cold sores, where you have to saw it off, and the other one's being burnt off. The aggregate is a lie. There's these two different forces. So I'm going to give just those 2 points. There's quite a bit more to our economic model, but I've been talking for a while, and hand that back to you. If the people can get the first 2 points of that, they're well on the way to understanding why oil price is down and gold just doesn't stop running.
Okay, I appreciate that. So let's switch over to gold here for a moment. China's been a net buyer of gold and a net seller of treasuries since about 2013, according to the data. They've been encouraging, probably way beyond this current generation, but because they've had through their history, they've had currency issues at different times. So their people are taught, they're ingrained generationally, it's handed down, you need to own gold. But the state has really pushed that, over the last, I don't know, however many years, especially as the Chinese economy, GDP, and the people have become wealthier and wealthier. So we have a situation now where Chinese citizens own gold while U.S. citizens do not, and instead they own treasuries. The more the dollar purchasing power gets debased and central banks move away from treasuries to gold, which is happening, the more U.S. citizens suffer and Chinese citizens benefit. In your analysis, is this why we're now starting to see so many more proponents of owning gold, where in the past, their message was, that's foolishness, it's a pet rock, it's a relic of the past. Why would you own a relic from the past, et cetera? So, we're seeing Morgan Stanley come out and say, dump 20% of your bonds in favor of owning 20% of gold. We're seeing more and more of this type of talk, proponents of owning gold. Is this why?
Oh, Riff, the final point you made about Morgan Stanley and that allocation, the investment banking cartel, and they have been a cartel, are largely responsible for the fiat and debt debasement. They've worked hand in hand with state to bring this about. I'm quite contemptuous of their sudden virtue and their attempts to get in front of a narrative once clearly things are shifting in a market. What tends to happen is it's almost like, I use this rather, JP Morgan and Morgan Stanley, etc., all live in a communal home, and they've been defecating on the porch. And they are part and parcel of bringing the standard of living in the communal home immensely down. And then they run around to all the other commune members and go, hey, watch out, it stinks like hell out there. Don't sit out on the veranda, as if they're the warners. They got their losses socialized and their profits privatized in the events of subprime. And what people don't realize as part of CV19 is the Federal Reserve lent over 21 to 23 trillion to banks. Lent, we have no idea what those terms were, and those articles have been immensely suppressed. And for the Americans' ire, let me also add, some of the recipient banks weren't even American banks. They involved some Swiss banks and one or two others. So the Federal Reserve debased your dollar, increased debt, and created loans that probably can't be paid back to make whole banks again with whatever derivative positions they had with regards to this ongoing Ponzi scheme. And what we're finally seeing is the cracks in the dam wall I was referencing and far higher levels of water coming down the river. And we're the guys that want the water sports. We built our houses on the high ground. We want to fish again. We want otters and beavers and deer and everything to come and drink down there again. There are other people that built right by the riverbank on the basis that it would never flood. And what's happening is those that don't see gold are those people. They don't recognize sound money for what it is, are those that are right on the riverbanks that will be washed away. And those, you and I, are those on the higher lying areas, well away from the future flood, but are looking forward to being able to fish again. And that we're starting to see them having to open all the sluice gates and some of the water coming over the rim. And yet the debt is continuing because you can't help it. You're borrowing to pay interest, continuing to be a parabola. So it's like all the glaciers upstream are melting, and not only are we flowing over the rim, but the volume of water is now coming so much faster. And that's what gold is showing. It's actually a great concern that we will be, a small group of very wealthy people in an environment where many will be deeply, deeply fiscally drowned. And that is going to be the...
Yeah, that's a I mean, I'm not disagreeing, but it is a dire picture. And unfortunately, so many are not paying attention. And, there's an arc there, and they're going to wait until calamity is striking to say, I need to get on the arc, but the door to the arc is going to be closed. But let's take this a little bit deeper, Francis. On the heels of the big banks giving these huge gold price predictions and portfolio allocation recommendations, Ron DeSantis, governor of one of the largest states in the United States and well known across, he spoke positively about the precious metals and negatively about fiat currency on X yesterday. I don't know if you saw it, but it seems like we're now in the mainstreaming of gold and silver, and that mainstreaming is now kicking into full swing. What does that mean in terms of what to expect moving forward if we're going to start to see this mainstreaming of gold and silver?
So we're going to go through all the stages of awareness. You and I were in the pet rock category of loons, saying, with people saying, I've been hearing these silver bulls for decades, et cetera, carry on. And now they're going to see and find out that those people were right all along. And it feels to me much like the events of CV19, to be honest. And the mainstreaming is they lose their power if it's quite clear they can't be trusted anymore. So they are now obligated and forced to start talking about the fact that cost of living is going higher despite a very soft economy, and gold is running like a madman. And the scale and the fact that this is being mainstream is their attempt to reframe as being legitimate. It's like all the posts, we've had a lot of admittals about the subsequent side effects of the event that occurred in March 2020, because mainstream media, people stopped watching it. So to retain any semblance of credibility, they have to start doing this. But they do it very unenthusiastically. Some of the headlines, not all of them, but many of them, some of the headlines more recently have said, and why it's dangerous for you to buy now, and various other things. So they kind of have to admit that something's happening and has moved. But by the way, it's all over really. And actually you could be, but they're very comfortable with a decade-long NASDAQ run, or at least 6 years. If we take the CV19 collapse, if we just take the NASDAQ since then, and in NVIDIA and the crazy valuations that have gone on there. So it's very self-serving, I will highlight. And secondly,
what about from the standpoint of incremental demand, that increasing incremental demand?
Well, you see, there's not a great deal of sales. So when they make something very popular, they make it very easy. For example, I'm using a slightly different measure, but remember, you were offered a McDonald's burger and all sorts of things to participate in the medical experiment. Gold, it's not a high commission product. You don't have an insurance salesman who's paid to come to your door. You have to get off your backside. If you're someone who's never engaged with gold, it's something completely new. It's like someone who's never played golf before has to suddenly decide to go get lessons. It takes quite a bit of inertia being overcome to do that. You have to find a bullion dealer. You probably have to go identify yourself. You have to say, hey, I'm new. I know nothing. You have to be weak and admit to your lack of knowledge and say, what should I buy? You have to go do research. And it's not something that is as commoditized as a product that they want you to be in, like, for example, instruments that they sell you in your bank or your trading account. To secure physical gold requires quite a lot. It requires storage, it requires planning, and quite a bit of that you have to work out yourself. You have to buy a safe, I assume. You have to decide whether you're going to vault with a non-bank or a bank. There's a fair amount of work, and there's knowing how to do this. It's not like they're doing, hey, front page article, you really should be buying silver and gold, and here's a bunch of stuff you should know, and there's coins, there's bars, and this is the difference, and there's tax benefits maybe on the coins, and you need to get a safe, and you need to do this, and you maybe shouldn't mention it. There's no one really wanting to do the full facilitation of the process for someone who hasn't done it before. So as I say, I don't think them talking about it, people read the financial news. Only if you're in the financial space would you probably start shifting. Many people don't care. You've got to remember the society is made up of nurses, plumbers, roof fixers, timber choppers, and various other things, not just financial people like you and I who understand the economy. So I don't think too many people will do anything. There's immense inertia. It slowly turns, and as you mentioned, you have family members for the first time pinging you. It's not yet the taxi man for me. It's not yet the shoe shine boy. And so I say we're still early. And I want to add a point number 3 to my 2-point list, and I'll do it promptly, is 80% of the gains, last 20% of the move. And I would say in silver, that's quite possibly 90 or even 95%. So whatever you've made so far, you might only be in the 5 to 10% zone. Wow. And so holding and not being shaken out by the media having regained its credibility is actually going to be used to say, okay, it's gone way too far. You all should be getting out now. That's when I double down and go, we're getting to the bit where the 20% comes.
Well, we've learned
coming soon, and we aren't anywhere near that.
Hopefully we've learned that the media is not to be trusted. So I agree with that point. So we are going to get to the charts, but a couple more questions. And we were talking about this off camera a moment ago. We saw as recently as 2022 that when oil prices go up sharply, inflation rips, the economy falls into recession, the markets drop, spending drops, and ultimately tax receipts drop. And, they can't have that in this current environment. With debt where it is today and debt servicing eating so much of the budget, it seems that the powers that be will not allow oil to rip higher and suffer a repeat of 2022. Therefore, they're a willing participant in this dissolving of the petrodollar framework that has existed since Henry Kissinger first negotiated it with Saudi Arabia. bottom line, until they get the currency and debt issue under control, it seems that they'll continue to work to tamp down oil and prevent some capex cycle from taking hold. And then once they get to the other side, maybe it'll make more sense then. And all of that is amazingly good for the precious metals miners. Your thoughts?
Well, the precious metals mining, I understand near the end of our chat, you're going to ask me to rate certain industries. And the only reason I won't give gold, silver, and platinum 100 out of 100 is I have to leave some space to put miners even beyond the metal itself. So, I'll be at 95 on silver, I'll be at 90 on gold, and I'll be at 95 on platinum, just so that I can say 100 or 99 on miners. And the reason for that is they have been greatly loathed for far longer even than the precious metals. So gold turned, you can argue, in 2000 in reality. Miners didn't really turn. Yes, they had a bump run in 2011 to the localized high of $1927 in gold, and then they came back even worse. They sold off even harder. So we've seen the market capitalization of miners to the point that they're so trivial of size and scale that the big fund managers and the trackers, they don't fall into any of those big funds. And what we've seen is the hyperscaling and hypermarket capitalizing of the surveillance state mechanism of the likes of Apple, Google, AI, meme amongst through all of them, etc. And we've got a saturation of capital in both the US in that specific venue and area for that side of things. Many of that development is highly speculative on how they'll get a return on AI, and we may well have to go through the dot-com boom and then bust cycle on. At the same time, you've got a crushed consumer, which is leading to very, very, and I've always said frame oil as the Rockefeller tax. When we were all, our houses were going up 15, 20% a year, 2005, 6, and 7. And we were all releasing equity and buying a new car every 18 months, cabriolet this, cabriolet that, living the large old life. They put a higher Rockefeller tax on it. And we hit 150, almost 150 oil in 2007. Now, that started to put a lot of a strain. And when we had the subprime crash, we collapsed down into the 30s or even the mid-20s. And what's happened is that was a depression and we never fully recovered, which is why the oil price had to drop on the subsequent sell-offs even lower, which includes CV19, where we went zero. So think of it as a heat thermostat that is skimming when you're flush, and they're charging you a lot for heat in the apartment. But when when everyone is crushed and doesn't have work or jobs, they lower it right down to avoid a complete collapse in other areas. Don't forget, they own both sides of the game. The central banks buying gold are the legacy families that own and are the shareholders of all the central banks. They own both the oil game, that's why I refer to it as the rocker, and the other. So the one hand takes a hit for the money to flow into the other hand. And what we're just having is, because of the consumer in the middle who's so crushed, we're going to have an extremity on the gold hand to the high side, and my other hand, which is right down there, that I'm tipping over. So when you have that understanding of framing, it's quite easy to see why inside the commodity groups, this is a theme. It is a reserve asset monetary theme based on the fact that the fiat debt debase system, point number one, is in collapse. Your dollar's buying power is the inverse parabola that you're seeing on gold when you look at the quarterly chart. And it's the same for the yen, it's the same for the pound. They all vary slightly, but they're all looking the same. So that is where we're at. I've got to refer back to your question because I think I've spoken around.
Well, I'm just hoping that folks are grabbing this because when it comes to the miners, because many people
the miners. That's right.
Many
the margins, they've got a parabola to the upside on their fiat-based gold price, which is the top line is doing that. And the bottom line, which is the cost line, is in a recession. And in actual, if you bear in mind that fiat is being debased as two, you have oil price going down. So we've called twice gold long, oil short. 2019 and again in 2024. Same technical pattern. I'll be showing it later. And it will go to a similar degree of extreme, in my opinion. And people are already trying to shake you out of your gold to get you to buy oil stocks or to get you to buy oil. And the point is, this is a secular reversal. And last time it ended in an absolute extremity. And they need those levels of extremity because people are such a large part of the population is just devastated by the oil cost. It's in everything: delivery, buying from Amazon, packaging, flying, travel, holidays, cruises, whatever you do. And so they really need to drop that cost and the heat they're putting through the sauna, so that because everybody's sweltering and falling like flies, right down and leave the door ajar. That's the reduction on the oil price to keep it. So we are in a worse economic shape. The main street, again, not the insider. There's a two-tier police system. There's a two-tier legal system. We're seeing communism, essentially, technological surveillance communism being uploaded, where there's a rule for me and a rule for thee. And they live by, we've got front running on Trump announcements, on crypto platforms, on Palantir contract awards, everything. It's a complete cacocracy. This isn't capitalism, but when it fails, they're going to blame it all on capitalism, because the antithesis of capitalism is in fact what they want, the technological communism, Bolshevik communism. But what you actually have is a two-tier system where there is no justice for front running, insider trading, for anyone who's part of the political classes that think they're elite. And that's where we are right now. And we're going to be hated. I want to put out a few warnings. The people that invested early, you're going to be weaponized. The exact same gaslighting that occurred, and this is why I keep drawing parallel. We got 2 strikes for medical misinformation as a result of March, trying to save people. And I can tell you why you're going to first get these people did this to you, broke the system. Gold investors, silver investors, you're going to be told you broke the system and brought the fiat system down. They will reframe it. The people that defecated on the porch always try to point fingers at the cleaners and the community members that were always doing the tidying up and trying to keep it in an orderly way. It is how it is. It is a great inversion, perversion. And you might even find you should have your community and friends all around you so that you can be safe. And when amongst normies, and we have a phrase called nominal normies, because everybody is thinking what an amazing stock market it is. The stock market and all other assets are really only moving up on account of fiat debasement. Your new benchmark, point number 4 on Francis's 4 points, is you measure your wealth in ounces of gold. There is no basis for accounting anymore. There is no fiat basis of accounting. You know, when you pay your taxes and you go and you have to tell how much revenue you made, and you said, I made $250,000 for the year and I had costs of 100. That basis of accounting is invalid. It's completely invalid and being debased at an escalating parabola to the downside. That is why gold is doing that. Gold actually holds its value. That's all it does. It doesn't have babies. It doesn't rust. It doesn't do anything. So what you're actually at is you're at the convexity, the steepening part of the curve of fiat debasement after the wall has held the water back for so long. And now it's flowing over the wall. All the sluice gates are fully open and the pressure is still building. The next thing is the wall bursts. That's where you make your 80% in the 20% time that I've been referring to. And let me hand back because there's quite a lot in there for you.
Okay, well, let's move into the charts for gold and silver. I don't think we need to spend, too much time in the charts, maybe just 3 or 4 minutes on gold, 3 or 4 minutes on silver. But one of the most important things that I do want you to address is that I keep hearing there are many analysts who are pointing to these historically high indicators like the RSI, that gold and silver are overbought and they are going to come plummeting down. We're going to have a sharp drop because that's how parabolas always end. And so I want you to address that as you're taking us through the chart.
100%. I will happily address that. It's very important people understand, and let me go to the share screens because I'm going to address a few things. And I think the one bugbear that's getting to me a lot is people not understanding how oil can be going down and gold can be going up. So let's address that. And at the same time, the indicator fallacy. We have done a video called the indicator fallacy, just because I have to deal with this all the time. So as a technical analyst, I started long ago, and I knew nothing like everybody else. When it started, I started really young. And, you get given moving averages and you get told price behavior bounces off moving averages. There's a lot of bad fallacy-based thinking. Now, moving average, for example, is literally, and I give this example, everybody, the US, many of you in rural areas or farmers or truckers will appreciate this analogy. If you have a dead cow in your river and the corpse is going to start rotting, you put a rope around its body, you tie it to your 4x4, your truck, maybe it's a Ford F-250, who knows, and it's all muddy by the river bank, and you get back into the driving seat and you tow the dead body out of the river. It's a bit heavy to lift by yourself, even with 2 or 3 people, it would be heavy. Now, the moving average is the dead cow. When you're driving and sliding around in the thick mud like this, towing this thing out, it's going to follow to a degree. But it's going to swerve to the left and the right, depending on whether you're on a gradient, whether you're turning the wheel. It's almost like a skier behind a ski boat. It can swing wide one side and wide the other side. But the only reason it's happening or moving is because of price. Price is your primary indicator. It's numero uno, price. And whatever the price does, the moving average will respond. So invariably, you never get that far away from the cow. So there will be times where it's crossing just behind you. But the cow is not telling you, you need to turn left at the next intersection as you're driving it. It's dead. The mathematics is the tow rope. It associates you to the cow. That's the only reason the cow's following you. It doesn't have some special wisdom. It's not smart. It's not a stalker. It's dead. And that's the moving average fallacy. So people think they're going to bounce off the moving average. It's the same as me looking in my rear mirror and saying, oh, the cow's crossed perfectly behind me. That means I'm going to turn left now or right. The engine and the driver dictate the direction the car and the cow goes at the end of the day. Moving average do not. Then you talk about RSIs, stochastics, and various other things. These are maths formulas overlaid typically on price data. The only indicators I make small exception for are ones that include volume. So on balance, volume, for example, we utilize. Why is it useful? Because volume leads. It starts before. RSIs, you can be in the overbought zone on a weekly, monthly RSI, and the price can just keep surging for years. And in actual fact, if it slows its rate of up but continues going up, the RSI can even start going down. And they'll go, you see, divergence. That means you're about to turn. All it means is the rate of change, the first derivative, has slowed for a while. So that's a bit the same as me getting into my Porsche Turbo S in Germany, hitting the Autobahn. And as I'm gearing through all the gears, I smash it right up to 300 kilometers per hour once I get onto the on-ramp just to stretch its legs. And then I start to cruise, and I, instead of trying to go to 350 kilometers an hour, it's top end, let's say, I let it just glide along at 301. That's like someone saying, oh, there's a reduction in the first derivative, the acceleration of the car. Therefore, it means he's going to turn around and go back home. No, it doesn't. It just means that he's not accelerating as fast on his larger journey of going from Bonn to Munich. And he's getting to Munich. And Munich's a long, long way away. And that's your goal price. So all the way along that journey, I might need to slow down for a truck. Not only will the acceleration go down, but there might be a small drop in my speed. There may be 3 lanes and someone's got into the fast lane and is only doing 160 and I'm still smashing along. I'm going to slow down right to 160 at one point until he gets out of my lane, and then I'm going to carry on up. So the notion of first derivatives always meaning reversal is a flawed fallacy. Because you're slowing down in the fast lane doesn't mean you're doing a U-turn and going back home. It just means you're slowing down in the fast lane. That's what it means. And RSIs and many of these indicators. So in our technical world, we use no price formula-based indicators at all. And my trading has improved immensely since I don't base any decisions on any of them. And it is so deeply entrenched because people that couldn't make money trading made money selling lines on computer screens. And because the computer says, everybody was saying, well, you've got to have that. Everybody tells you you have to do that. There's not enough people that question. There's a whole cottage industry on indicator writers. And it's the one thing you can be assured I'll never write. We trade patterns. We watch volume because it's leading indicator. Every technical price mathematical formula is a lagging indicator, and it is responding to the price lag being put through to the formula. So actually it's designed to try smooth and simplify something, which actually is not always meant to be simple. Sometimes it's volatile. Volatility, volume, patterns. These give you key opportunities in trading the markets. And the HVF method, the Hunt Volatility Funnel, is actually when we get exceedingly tight in volatile moments in a continuation pattern, which I am doing every day in the gold and silver bull runs. I am putting in regular short-term trades with big size, with very tight risk, getting the expansion, closing, taking the profit, reducing the size right down, and have another long-term trade that I'm letting run and run, while all the RSI guys, the MACD guys are all saying, we've never been this high before. You've never had a run this big. That's why. And it's only just really getting started. They're only just starting to talk it on the mainstream. It is bigger than you can imagine. It is the death, the economic fiscal death of a fiat-based lie system of immense fraud that is being perpetuated and still not being acknowledged by an entire Western nation that continues to proliferate in a fraudulent manner and is not buying meaningful amounts of gold, with the exception of Poland and some Eastern European nations. They are continuing to splurge, fund wars, and do everything else, knowing they are going bankrupt. This is like your last credit card after you've maxed out 20 of them and you can't, and you're behind on making all the payments. You're going and buying toys and goodies and holidays for your family. That's where we are in the West.
Well, I appreciate the analogies with the RSI and some of the other indicators. I'm excited to get into the charts.
Yes, let's go straight to that and let's show you the chart. So the one that I've alluded to a couple of times that warrants illustration, Gary, let's get straight to that. Yeah, so hopefully you're seeing there's quite a bit on here. So I'll just first take the line off and I'm going to take those. I've got a particular indicator that I will also take off initially. If I re-add the lines back, I will show you 2019's call and why we repeated it. It's very rare you do a macro same as before call within 3-4 years on macro. We're macro technical analysts. So what that means is I like looking at big charts. This is a weekly chart. It's not, I look at a lot bigger ones, in fact, but this is a weekly, which is quite typical of us. And this was, and what are we looking at? Gold divided by oil. So this is a relative strength period. Here you have the 2019-18 lows where oil was pretty expensive and gold was not doing particularly well. And you had this particular pattern, and I'm going to illustrate it. That is called a shoulder. That was also a shoulder, and this was a deeper head. And we said, you will run 52, and you were down here at about 15. And the neckline, this line that's typically drawn, I'll actually get a nice straight line instead of freehanding that, was around 28. And it's an amazingly common number because we're going to see that 28 come again. So remember, this is pre-COVID. This is behind us saying, go long gold, short oil, before anyone had heard of CV19 in 2019, first half, mid-year, right the way into November. What then happened is you triggered there where you should be, you know, you could have bought 100,000 leveraged gold and you would have used 100,000 collateral of oil short. And this is what transpired. As I roll you through it, let's just take that off now. And we go forward, bang. That was the events of CV19. Now, that was super extreme. Then you had the big reversal, and we called it all the way back down. You had a bear flag, you came all the way back down, and bringing you to 2022 now, we actually had oil back up at $129, and we had gold in a 3-year since 21 going up and down, battling with the $2,000 mark. You may remember that. And what did we get? We got the exact same technical pattern. And on the same 28 neckline, which is very, very ironic. There's the head. And these are secular reversals. We have all over our YouTube, on our channel, including shorts, telling everybody you're going to go from 28 barrels of oil for 1 ounce of gold. That means you take your 1 ounce of gold, you get 28 barrels of oil, and you are going to run these 52s. And it's a major reversal. The 52 is not the top. It's a target where it might get one fairly significant pullback, and then you will continue as part of that reversal. So head and shoulders are cyclical tops or cyclical bottoms. In this case, we're calling a bottom. What's happened since then? And this is what everyone hasn't realized and everyone's now squeaking about. There you go. You ran our targets at the 150. You had the most significant pullback once running our targets, and now you are in a melt up, continuing on what is a main reversal right the way down at 14 that triggered at 28, and you have gone now from 28 barrels to 73. That's huge. And at that bottom, when oil was 129, you were again at around 14. So we called a 14 to 73. I don't even know how much that is. It's maybe 5x move in relative valuation, which you could have had a cross-commodity spread trade. At the time, oil was $87 when we were first talking about it. This is now a year. It's trading in the 50s now. You would have made money on your short leg as well as huge amount on your gold long leg. This is showing you that not all commodities are equal. This is the thermostat where they take the pressure off the consumer when you are in a recession, and with what I'm predicting, likely a depression if you stay in the West. Which is why if you're a high energy, good business runner, why not go somewhere else where people will have some money? Anyway, this is not going to turn in a hurry. And I don't think, look, it's going pretty strongly up. It will have corrections, but be warned, they need to keep the cost of oil down to keep their businesses afloat. And this is what's happened last time. Don't call a top on this. Why? The theme for this crash, the previous theme was, you know, the flu thingy. The theme for this crash is far larger even than CV19. They've needed ever bigger events from subprime, .com, subprime, CV19, shut down everybody's small businesses except Amazon that will still deliver. Now they need the mother of big events, and you know what it is? It's a depression for the Western world. We've had much higher standards of living for ages on an IOU, fake, phony fiat system that moved away from sound money. And the truth wolf is now at the door. I don't want to be in that house when the truth wolf comes. I'd rather be on his team on sound money. This will go higher. It could even be worse. You may even see single digit oil again. And no one, I've heard no one who could predict that. We've got head and shoulder targets at 32 and sub $1. You could see it again. That doesn't mean it's a majority opinion. You know, people are pricing that at 0.1%. We'd price it at 15%. That doesn't mean I'm saying it's happening. I'm just pricing it a lot higher as a potential risk.
But even for those who are watching, as long as gold stays fairly elevated, if not continues to go higher, and oil stays muted or maybe goes lower, the miners, their margins just continue to rip higher. I mean, at some point, mainstream has to pay attention.
Yeah, miners are going to be face melting. The only reason I don't own disproportionately more is my lack of confidence in getting certificates. and the great taking threat. Otherwise, I would actually be even more overweight miners. I do have them, and they are all majorly outperforming. But I fear that such is the counterparty risk, the fraud, that if you can't have, and even if you do have a certificate, you have a piece of paper. Remember, when you hold a gold ounce in your hand, they need to send a man with a gun to get it off you. Right. And if you're armed, they need to send an army. Paper means you have a legal claim in an environment where a lot of illegal things are going down.
Yeah.
So that's the only reason my gold miner portfolio is not, I am more bullish in terms of price performance. I have more counterparty risk concerns with paper than I do with physical.
I think that's a very, very valid point. Okay, so before we wrap up, would you just give us your take on silver? What are you seeing in the charts with silver?
Oh, such a beautiful event occurred. That is a mass triggering event. So for the record, by the way, we have already said, not the high point, but that the silver price will have a resting point at $330, a significant resting point before going higher still. So there aren't too many people that come in with bigger numbers. We do see eventually 4 digits potential in silver when we get a gold silver ratio that is lower. So our HVF method, which is a unique pattern, got us in before all the cup and handle callers. I'm just going to make this a quarterly chart because it's such a long duration. This is the biggest pattern of our favorite setup we've ever traded. And I've been in the markets for ages, by the way. This started in my childhood in the run-up to 1980, this setup. And that was our triggering point to go long right there. And you can see this is 3 months. That's a quarter. Each candle represents 1 quarter of a year. And this target that we get out of here is way, way up at $330 on a log scale chart. And then we see 600, and then we will see 4 digits. We've called for a single digit gold silver ratio in an overreaction moment period. That means 9.99 potentially or lower in gold silver. So you could have a situation where gold is, 15,000, 25,000, and you could wherever it's going to be a very strong high, localized high, it could even be 108,000. That silver is 1/10, less than 1/10 of, more than 1/10, my apologies, of the gold price. So we think you'll have a moment. I don't think it stays there forever. That will be, you've got to have a point where you are getting out. You can't be such a bull and believer that it's forever only up. But when you drop below single digits in the gold silver ratio, I'd certainly be selling off my silver to some degree at very minimum. And I think that's going to be a key moment. I'll reduce by more than half and possibly even 3/4. But that's not anywhere near on the gold silver ratio right now. Gold has had such a head start. We're still in the upper 70s. On the gold silver ratio. We need to see that break down 30s. You'll have a pause at the 30s, the long historical 30s, and then you'll drop it further. So silver is just gold plus steroids and a turbocharger, basically, and a line of cocaine if you want, if that's your bag. It's not mine. But it's just the more extreme version, and it's got an incredible price projection future. And unobtainium, I think there'll come a point where it will be illegal for retail just for bullion purposes to buy. It will be deemed too strategically important and will be industrially traded. And you'll sell your premium, you'll sell your bullion for premiums to whatever the spot market is at some point in the future.
I can't help but agree with that. And, running a 5-year supply deficit, seeing countries like China, India, and Russia starting to store it and purchase it from a sovereign level. Other countries are starting to talk about doing the same. Every single, industrial component is ramping up, not scaling back their need. And we're only getting started on AI, robotics, data centers. And then there's, military weapons and defense, and they're going through a cycle as well. So, it just seems inevitable that
Gary, it feels to me like a world got seduced and decided to go into a parallel universe dream stroke nightmare of the financialization of everything for the better part of 40 years, and maybe even before that. And suddenly they've all been woken up, and certain nations said, you know, it's time to head back towards truth. Unfortunately, the Western nations are not the leaders in that space, but the others are. And the minute a certain amount of people in the room wake up, the whole room gets forced to wake up. They can choose to act, or they can look dopey and sit there and just wait for the building to fall on them. But the smart people are getting out of the building, and they're taking their assets with them, and they're taking those assets in silver and gold. And the sleepers, the 40-year, hey, Fiat floats, we'll never exploit this, you can trust us, and we got the biggest military and all of that, rah-de-rah-de-rah, and the superpowerdom and all of that based on a lie and a Fiat and a Ponzi scheme. It's like everybody's waking up from a nightmare. And it's either going to be a great life that you got out of the nightmare and you acted, or you continued to be a sleeper and you never woke up and the building went down on you. And, you know, it really is, because what's controversial about sound money and having a true fiat systems being debased? It's a given that that's going to happen, given human nature and power.
Francis, would you care to unshare your screen again? This has been an incredible discussion. I just want to welcome everyone who's tuning into this fantastic interview with Francis Hunt, founder of the Market Sniper. Before we wrap up here with our final question for Francis, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community. You're going to receive a free gift. It's a report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the free report. I'm also positive you've been enjoying the conversation Francis and I have been having. Please let him know. Hit the like and subscribe button. Leave a comment below the video. In the interest of time, instead of us doing the lightning round that we discussed before we started, would you please share a key takeaway that you want all the viewers who are tuning into to take away from this discussion, and then let everybody know where they can learn more about your work and how they can connect with you?
Certainly, and thank you for that, Gary. Gentlemen and ladies listening to this, this is the most, you were chosen to live in these times, and the theme of what I'm discussing is my obsession, and it is the overarching theme, and you will feel the gravity of the events that are currently transpiring, for which this gold and silver moves are a tweeting bird in the tweeting canary in the gold mine, if you like. The scale of the social, the governmental reaction, and everything that goes hand in hand with a fiat debt-based collapse is not being represented to any true scale in anything you are watching and reading right now. It is so vast and so destructive that it requires unique preparation. Your forefathers never lived through this. The scale is so large. Yes, they had challenges with the World War II and everything else. My raison d'etre, which is a fancy French way of saying my reason for existence, is not only to navigate this accurately, purposefully, and intelligently, but to assist others in doing so. My YouTube channel, The Market Sniper, is about building further wealth, for which the gold and silver theme is the overarching and predominant theme. Protecting that wealth, because governments are going to go into complete scavenge mode on taxation now that they can no longer borrow on a bottomless overdraft, which was sneaky tax of you. They come direct for you. On property taxes, every other form of taxation, you're going to experience scavenge mode by governments. And they're going to be cutting the services, reducing it, and coming for more tax. So you're going to pay more for less. You need to protect yourself from this, secure optionality, point number 3, and freedoms in environments where you can have arbitrage against your legal system of your home nation. All Western nations are going to experience this to varying degrees. Sadly, for my American audience, the hegemon falls from the highest ladder and gets the most injury in this great fall. And you really need to think about how you are prepared, and having jurisdictional access to gold outside your country, because you won't believe the rules, the laws, and the draconian nature that they will revert to when they are desperate and they can no longer fund their existence. The Market Sniper YouTube channel is where you can follow our technical analysis. We see a role for crypto. We don't trust it. We trade it to build wealth. The Crypto Sniper, and I'm on X under the Market Sniper. And there are links where you can book a chat to have a chat with our team, should you wish to become part of our community, securing all these aspects, which include offshore bank accounts, residencies outside the US, et cetera, and other nations. Thank you for having me on, and I look forward to our next chat already.
Francis, thanks for coming on to Metals and Miners. You've been so generous with your time, analysis, and ideas. It's always wonderful to spend the time with you. I look forward to having you back on sometime soon. Everybody else, thank you for watching. Before we wrap up here with our final question for Francis, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community. You're going to receive a free gift. It's a report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the free report.